I think the fuse is lit. I've said for years I thought that uh, silver would be the fuse on gold, and it's looking pretty squeezy right now. When I say squeezy, from the short squeeze standpoint, we've been in a supply deficit for 5 years, and that's only broadening. It's not coming back to balance. And the only thing really that can balance the supply deficit out are higher prices. Now, the problem in the metals industry is that the supply chain is relatively inelastic time wise to price. You could discover gold or discover silver today, hit the mother lode, but you won't be in production for 7, 8, 10 years just because you've got to build out the infrastructure. You've got to get all the permitting, et cetera, et cetera. So it's an unusual market compared to, say soybeans or whatever. You just plant more for that year to make up for a deficit.
Silver is being acknowledged as a strategic asset, with a growing emphasis on its function in industrial demand and financial security. Tweet. Bill Holter, a market analyst, has emphasized the significance of the United States government's recent decision to designate silver as a critical mineral. This classification could potentially limit its availability for commercial markets. This designation indicates a change in the metal's value. It is no longer merely a commodity, but a resource that is prioritized for national security. The implications are evident to investors. As the strategic significance of silver continues to increase, it may become more challenging to acquire physical silver. Holter emphasizes that the consequences of this policy are far-reaching and extend beyond the confines of the United States. It is probable that other nations will follow suit, retaining a greater portion of their own production as industrial and strategic requirements become more pressing. Simultaneously, sectors such as renewable energy, electronics, and medical technology continue to be significantly reliant on silver, limiting the potential for substitution. Holter cautions that delivery failures may occur, resulting in systemic stress across financial markets, as paper markets are already overextended in comparison to the availability of physical metal. Few investors are adequately prepared for the potential volatility that is being set in motion by the delicate balance between unrelenting demand and constrained supply. Bill Holter contends that the future is determined by both extraordinary risk and unprecedented opportunity. He observes that silver has been undervalued in relation to its significance in the global economy for an extended period. However, a significant breach of the $50 per ounce threshold could indicate a significant shift. He contends that such an action would not merely signify another rally in a volatile commodity, but rather the commencement of a revaluation process with global implications. In that event, speculative demand could experience a significant increase, resulting in prices reaching previously unattainable levels of $100, $200, or even $600 per ounce. The following are the excerpts from Bill Holter's interview with Andrew Maguire. Please subscribe to our channel and activate the chime icon to receive timely updates before we proceed with our discussion. I appreciate your assistance and hope you enjoy the video.
Yeah, I think the fuse is lit. I've said for years I thought that silver would be the fuse on gold, and it's looking pretty squeezy right now. When I say squeezy, from the short squeeze standpoint, we've been in a supply deficit for 5 years, and that's only broadening. It's not coming back to balance. And the only thing really that can balance the supply deficit out are higher prices. Now, the problem in the metals industry is that the supply chain is relatively inelastic time wise to price. You could discover gold or discover silver today, hit the mother lode, but you won't be in production for 7, 8, 10 years just because you've got to build out the infrastructure. You've got to get all the permitting, et cetera, et cetera. Um, so it's an unusual market compared to, say soybeans or whatever. You just plant more for that year to make up for a deficit. You can't do that with silver. And I think ultimately, silver is going to fail to deliver. Um, in my eyes, that's within the next few delivery periods. So I think before year end, you're going to see the silver market break. Uh, that will immediately spill over to gold. And the problem with the gold market breaking, when I say break, I'm talking about uh, contracts basically going to zero and physical being not obtainable. The problem with that is gold is a thermometer, barometer, whatever you want to call it. Uh, much, much higher prices means that confidence has or is breaking. And the entire Western world's financial system runs on confidence.
And I remember you long time ago saying, arguing that, it's not that the price of gold has gone up. It's just that it's taken more debased dollars, euros, yen, whatever, to buy that very same ounce, which has not changed at all.
Right. An ounce 100 years ago of gold or an ounce today or an ounce 100 years from now is still just an ounce of gold. It doesn't change at all. The only thing that changes is the measuring stick, and that measuring stick are currencies. And currencies worldwide are going down because gold has broken a new highs in all currencies. Matter of fact, the dollar from $35 in 1971 to $3,500 plus now, that's over a 99% drop in purchasing power. And that's happening with other currencies. And we can talk about yields, if you'd like, sovereign yields, because they're going higher worldwide. And that's the real tell as to what's happening.
Yeah. So what are you seeing? I mean, what are you seeing as far as, yields are going? I mean, see it in this country, we see gilt yields going through 1998 highs. What's happening on your side?
Well, yields across the board, sovereign yields are defying, if you will, what the central banks are trying to do. The central banks have started to cut. We're going to probably get an interest rate, a Fed rate cut this month in September. Go back a year ago, the Fed made, three cuts totaling 1%. So short-term rates dropped 1%. But while that was happening, long-term yields rose by 1%. So I think the danger with this September rate cut is that they cut rates and we get a sell-off in bonds. Now, that said, well, that would show the Fed losing control of the yield curve. And that's important because obviously, it's the biggest market, and all financial markets are based by a foundation of paper, of U.S. Treasuries. Now, that said, I think the most important yields to watch are the Japanese 10 and the Japanese 30-year bonds. And the reason they're important is because for years and years and years, when Japan was zeroed out as far as interest rates, the yen carry trade is what a huge factor in blowing this bubble to where we've gotten to. And a stronger yen and higher interest rates or lower bond prices, what that does is that's going to unwind the carry trade. So for years and years and years, leverage was put on the long side. And with these much higher yields and a stronger yen, that carry trade is being forced via margin calls to unwind. And when you get something of the size of the carry trade unwinding, it cannot ultimately be a slow, conservative drop. I mean, this is going to it'll be some wild times.
In the past few weeks, silver has garnered renewed attention as governments and industries attempt to secure resources that are essential for the transition to advanced technologies and energy sources. The market is already exhibiting evidence of strain, as inventories on major exchanges continue to decline, according to analysts. Bill Holter cautions that the financial system may experience an unprecedented disruption if silver prices accelerated rapidly. This scenario is referred to as the mother of all margin calls by him, as it involves the unraveling of leveraged positions, paper contracts, and derivative exposures associated with silver due to real-world scarcity. Holter emphasizes that such a disruption would not be limited to metals trading. Rather, it could have a ripple effect on credit markets, potentially eroding the confidence that underpins global finance. The outlook is further complicated by silver's dual identity as both a monetary and industrial metal. The demand for silver is increasing not only from investors, but also from sectors such as renewable energy, semiconductors, and defense, where it is indispensable. In order to preserve the advantage of physical holdings in a constricting market, certain mining companies are already signaling caution by withholding supplies. This historic turning point is indicated by the convergence of financial duress, government intervention, and industrial necessity. Holter proposes that the divergence between physical silver and paper claims is expected to increase, resulting in a market in which actual ounces command a premium that traditional pricing models will be unable to capture.
High, we're 4.25 thereabouts now on the 10-year, but that was the high on the move. Up from, well, I mean, at one point in time, I think the 10-year traded as low as 0.6 of 1%, or maybe even lower. So it's been a huge move already. And, I don't know if 5% is the number or not, but there is a number that unwinds the entire credit edifice. Because what you need to understand is that the entire world, whether it be financial markets or the real economy, everything runs on credit. And if credit becomes more expensive because it is being shunned by foreigners, how does the U.S. How does the U.S. fund a $2 trillion deficit? That's an extra $2 trillion every year that they have to borrow. And the answer ultimately is the Federal Reserve will buy those bonds. But that is, outright and direct monetization. The problem that the West is in right now is it's a debt trap. I mean, in the U.S., we're paying $1.5 trillion in interest alone. You've got problems in France. You've got problems all over the world with sovereign debt. There's too much of it. How do you service it? That's why they're desperate to get yields down. But Mother Nature, market, is pushing rates higher. And that's where rates should go because there's more and more risk. There's little to no risk premium in sovereign bond yields across the globe.
And so essentially, I mean, the way that just so subscribers understand what we're talking about, so yield curve control is essentially going to flood the market with cheap money, isn't it? And so what's your hedge? Global central bank gold buying is going to certainly be incentivized. What's the hedge for most people?
Yeah, well, the obvious hedge is gold and silver, and the reason being, gold nor silver can bankrupt. They are money themselves. They cannot bankrupt in a world that is bankrupting.
Absolutely, and I think if we can revert back to silver for a minute, because what we're seeing here is a huge, long-awaited breakout. I mean, obviously, we all know that China has been in the driver's seat for a long time, and they've been playing the arbitrage trade and, being in control of the physical side of the market. They could arbitrage the paper side. But essentially, what we're hearing is, hey, gloves are off now. And especially after Trump's most recent BRICS attack on the BRICS, like clearly putting the BRICS in the crosshairs with tariffs, and then most recently some very odd statements that he made after the SCO meeting. What's your thoughts there?
Yeah, I think your comment, the gloves are off, I think that's Up until this point, I mean, it would be extremely easy to break the Western financial system with $5 or $10 billion. I mean, if you went into COMEX and LBMA and said, "Here's $10 billion, I want metal," it'd be over. Um, it, there's no way to deliver uh, that kind of metal short term. So it would break the markets. Uh, in the past, I want to say that Russia, China, the rest of the world were being polite because they didn't want bombs raining down on them. One of the big things, the reason the dollar has been the reserve currency for so long is the U.S. military. Basically, we forced the world with threat of the U.S. military. If you don't use dollars, I mean, look at Saddam Hussein. Look at Gaddafi. They both talked about, 15, 20 years ago about doing a gold-backed currency, and what happened? They were killed.
Mm.
In the past, countries have seen, those two examples, Gaddafi and Saddam Hussein. They saw those examples and said, well, yeah, we'll just buy it quietly. And now that the war of words is on, it would not surprise me to see either a country or countries together step up. And the Achilles heel to the Western system is the fractional reserve nature of the entire system. But the way to expose that is just create a failure to deliver in either silver or gold, and it'll be both within 24 hours. If either goes, the other's going to go within virtually immediately. So they're at the point now, like you said, the gloves are off, and money is just flowing into whether it be.
With the recent breakout above $42 per ounce, silver's price action has entered a decisive phase, indicating a shift that is driven by fundamental strength rather than speculative trading. The move is indicative of the increasing expectations of a dovish Federal Reserve stance and the tightening of physical supply conditions, both of which are supporting higher valuations. This level currently provides a robust foundation for ongoing momentum, as market dynamics indicate that additional gains are imminent. In the future, the next significant test will be the multi-year high near 44 forward TT large 22 to $200 per ounce. If this threshold is breached, it could unlock additional upside potential. Analysts anticipate that silver will experience sustained growth in the near future, as industrial demand continues to increase and physical markets exhibit signs of stress. As silver approaches new milestones, its favorable outlook is further reinforced by the weight of both structural demand and monetary factors in the price trajectory. Is the recent increase in silver's price indicative of the onset of a long-term upward trend? Please share your insights in the comment section below. If you find this video to be informative, please consider supporting our channel and activating notifications to remain informed about our most recent content. I will see you in the video that follows.